Brad Williams, Frugal Finance, hedging with T-bond futures. This section begins with an example of a cross-hedge AAA rated corporate bonds. Sample shows that a single hedging rule of using $1 of futures per dollar bonds can lead to horrible hedging results. This example leads to a discussion of alternative hedging techniques focusing on hedging with T-bonds. In all previous hedging examples, the hedged and hedging instruments were very similar. Often, however, the need arises to hedge an investment that is very different from those underlying in the futures contract. The effectiveness of a hedge depends on the gains or loss on both the spot and future side of the transaction. The change in the price of any bond depends on the shift in the level of interest rates, changes in the slope of the yield curve, and the maturity of the bond and its coupon rate. To illustrate the effect of the maturity and coupon rate on hedging performance, consider the following example. A portfolio manager learns on March 1st that he will receive $5 million on June 1st to invest in AAA corporate bonds that will pay a coupon rate of 5% and have 10 years to maturity. The yield curve is flat and assumed to remain so over the period from March 1st to June 1st. The yield on AAA bonds is 7.5%. Since the yield curve is flat, the forward rates are also 7.5%, so the portfolio manager expects to acquire the bonds at that yield. However, fearing a drop in rates, he decides to hedge in the futures market to lock in the forward rate of 7.5%. The next step is to select the appropriate hedging instrument. The manager considers two possibilities: T-bills or T-bonds. However, the AAA bonds have a 5% coupon rate and a 10-year maturity, which does not match the coupon and maturity characteristics of the T-bill or T-bonds deliverability on their respective futures contract. The deliverable T-bills have a zero coupon and a maturity of only 90 days, while the deliverable T-bonds have a maturity of at least 15 years and an assortment of semi-annual coupons. For this example, we assume that the cheapest to deliver T-bond will have a 20-year maturity at the target date of June 1st, and that the cheapest to deliver bond has a 6% coupon. Have I lost you? I hope not. To explore fully the potential difficulties of this situation, we consider hedging the AAA position with T-bill and T-bond futures. We ignore the T-bill notes to dramatize the need to match coupon and maturity characteristics. For the bills and bonds, we assume the yields are 6 and 6.5% respectively. Assuming that yields remain at 7.5%, the bond in which the manager plans to invest will have a price of $826. With $5 million to invest, the manager anticipates buying 6,051 bonds. Table 616 presents the hedging transaction and the results for the T-bill hedge. Because $5 million is becoming available for investment, assume the manager buys $5 million face value of T-bill futures contract. Time passes, and by June 1st, yields have fallen by 42 basis points on both AAA and the T-bills, respectively. The price of the corporate bond is $852.72 or $26.42 higher the anticipated price of $826.30. Since the manager expects to buy 6,051 bonds, this means that the total additional outlay will be 6,051 times $26.42, or an additional $159,867. And this represents the loss in the cash market. In the futures market, rates have also fallen by 42 basis points, generating a futures price increase of $1,051 per contract. Because 5 contracts were bought, the future profit is $5,250. However, the loss in the cash market exceeds the gain in the futures market for a net loss of $154,000. Note that this loss results even though rates changed by the same amount on both investments. You're saying, what the heck happened? A cross-hedge between corporate bonds and T-bill futures. A portfolio manager learns. I'm not going to repeat this. This is just this example, this information I just read. Okay, reread this if you need to. But we're going to move on. Consider now the same hedging problem, but assume that we implement the hedge using $5 million face value of T-bond future, T-bonds. We were using T-bills and T-bonds in the previous example. Table 617 presents the transaction and results. Again, Yields fall by 42 basis points on both instruments. Consequently, the effect on the cash market is the same, but the total futures gain is 231,650, more than offsetting the loss in the cash market and generating a net wealth change of 71,783. The goal of the hedge is to secure a net wealth change of zero. A gain is approximately viewed as no better than a loss. It is only by accident of rates moving in appropriate directions that the gain was not a loss anyway. Recall that all of these simplifying assumptions were in place: a flat yield curve with rates on both instruments moving in the same direction and by the same amount. However, as noted earlier, the coupon and maturity of the hedged and hedging instruments do not match. All three instruments, the bond, the T-bill futures, and the T-bond futures, have different duration, reflecting different sensitivity to interest rates. Consequently, for a given shift in yields, 42 basis point, the price of the three instruments will change by different amounts. Therefore, a simple hedge of $1 in the futures market per dollar in the cash market is unlikely to produce satisfactory results. So here, a cross-hedge between corporate bonds and T-bond futures. Portfolio manager learns or will receive $5 million to invest 5% 10-year AAA bonds in 3 months with an expected yield of 7.5% and a price of $8.26. The manager expects to buy 6,000 bonds. Portfolio manager buys $5 million face value of T-bond futures, 50 contracts to mature on June 1st, with a futures yield of 6.5% and a futures price per contract of $94,488. AAA yields have fallen to 7.08, causing the price of the bonds to be $8.52, representing a loss per bond of $26.42. Since the plan was to buy 6,000 bonds, the loss is 601 times 2642 is 159,000. The T-bond futures yield has fallen to 6.08. So the futures price is equal spot price equals 99.081 per contract for a profit of 46.33 per contract. Since 50 contracts were traded, the total profit is 231. We'll get into why this happened as we move forward. Net wealth change, the profit was 71,783. Brad Williams, Frugal Finance. Thanks for watching.